I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's guest is someone with the essence of insurance running right through his veins. That's because he's been working in our industry since the age of 16 and has accumulated over 40 years of experience. Now, as CEO of the Lloyd's and Bermuda insurer and reinsurer Antares, Mike van der Straaten has a unique viewpoint of the global insurance market from which to apply his accumulated knowledge and understanding. Like many of its peers, Antares has undergone a rebuilding and restructuring in the past few years, and after steadying and right-sizing its business, is now stepping out to seek measured profitable growth once more. I found this a really enjoyable and enriching discussion. In a world seemingly dominated by PhDs, Mike's remarkable career is a reminder that when it's performing as it should, the insurance industry is an education and vocation rolled into one, and rewards intelligence, creativity, common sense and hard work in the most meritocratic of ways. Mike is a great guest and blends the best of the old and the new. For example, in this podcast, we examine many of the factors that don't change, such as the shifts in the market cycle and distribution trends. But at the same time, we also dissect some of the most progressive issues affecting the sector, such as the best applications of AI and the streamlining of the underwriting and placement process. Mike always says what he thinks, and this candour is extremely refreshing. Listen on, you'll learn a lot, but you'll also have fun. Enjoy the podcast. Mike, welcome to Voice of Insurance.
Thanks for having me.
Anyone who doesn't know you, why don't you introduce yourself and give us a bit of a potted history of your career and how you got to where you are now?
I'm quite old, I'm 57 now. I started in 1984, straight from school at 16. Worked for a Lloyd syndicate and then moved to an insurance company in London, then overseas to a European reinsurer. After the stint with Europa, I then opened an office as a Lloyd's cover holder for 10 years.
Did Rolf Tolle work in Europa?
He was my boss.
Glad I remembered that. Sometimes I misremember these things, but yes, I did remember that.
And Daria Vanus as well. She was there at the time. It was very good years. I learned a lot about reinsurance, all different classes of business, which allowed me to move on to the Lloyd's cover holder. And then 2012, we were purchased by Canopius, and I got a job with Ace Tempest as Deputy Head of London. I did 3 years there and then moved to Qatar, UK, to head up their London branch at the end of 2016. And I've been at Antares or QIC since beginning of 2017.
That's a really good introduction. So you've had a really varied and interesting career. And actually, I'd say, yes, the Qatari Antares story is actually quite varied and interesting as well. So again, you've had a bit of a reorganization. So now would also be a really good time to give us a bit of a guided tour of Antares and how it works and how it sits within that wider Qatari group.
So when I joined, there was also the Antares syndicate, and Qatar was a separate entity. What's transposed over the last couple of years is we've actually merged and become Antares Group, which actually has a much more beneficial brand and collaboration within the group. We did have 6 entities. We're now down to an Antares Re in Bermuda, the Lloyd syndicate, and a new Antares insurance company in London. Really, they're the 3 focal points of this group. Obviously, we're owned by the Qataris that are based in Doha, but we cover reinsurance and insurance business throughout the world.
And what sort of GWP and sort of how many people does that entail these days?
We have around 400 people. We actually restructured the business, moving away from an entity basis. We've gone into retail, commercial. So our retail book is some 400 million and our commercial book's about 800 million. The syndicate obviously writes commercial and retail, and the insurance company was really set up to be a retail writer. Antares Re in Bermuda is predominantly commercial. What this allowed us to do is to offer the product in the globe to the same clients with one real plan, if you like, and strategy.
And retail commercial, where's that predominantly based? Which geography is that in?
So retail is pretty much the UK. We did have a Maltese insurance company where we accessed UK from Europe. But obviously after Brexit, the complications of doing business where most of our expertise laid, which was in the UK, made it a tough decision that we would actually try to sell the Maltese insurance company and set up in the UK, which we have done. And we actually have a lot of opportunities in the UK.
I suppose actually at the time, there were probably lots of people looking the other way, wanted to buy a Maltese insurance company. Maybe it wasn't that hard to sell.
Actually, we do have a list of people that are interested in buying a Maltese insurance company.
Well, anyway, anyone out there listening?
You have to be quick, though, because...
Well, there's only one. There's only one to go. So, yes, the stock is very limited. You're also founding an MGA. What's your thinking behind that?
So our insurance company in the UK is really writing business through MGAs. What we proposed to do was, if we created our own MGA, these MGA people would go and visit any MGA that would like to use the insurance company. And that MGA would kick the tyres to make sure that it's fit for purpose. Passing the standards and the analysis that our MGA gave, it weeds out the ones that are not fit for purpose or not within appetite and allows the ones that we feel could be a good partnership to go forward to the insurance company. That's one strand. The second strand is we've actually created a property retro MGA called Asteri Re, and that is being looked after by our MGA. And we've also got other interested parties that would also like to participate in our MGAs. So it's opening a different distribution level for us.
Right. Okay. So is it fair to say, is it one of those sort of like an incubator MGA that has lots of other MGAs on it? Or is it a way of hiring underwriting talent in a slightly different way, or i.e. getting that underwriting talent to be writing on your behalf? But they're perhaps the sort of talent that wouldn't want to come and work for the balance sheet company.
I think what we're finding is that there are a lot of people that have very profitable portfolios in the UK, and I don't think they're being rewarded as they see fit. And we offer a different way to maximise those financial dreams and produce business for us, which increases our distribution and our portfolio spread.
So the expertise is that they can go and kick the tyres of other MGAs because they know what to look for.
Yeah.
And then they'll present them to you and you to be the paper behind.
If they pass the test with our MGA, then they get to talk to the insurance company. If they don't pass the test, then it's thank you very much and find somebody else.
And in terms of the kind of business, so you've got the property retro, so the idea of having third-party capital as well sitting alongside you.
We're offering, if people are interested, they can join, and we've already got a few interested parties following this renewal season.
That's really interesting, because I presume it's just another way of participating in business, perhaps, that you don't want to take 100% of. Is that the way that you see it?
Previously, everything was done via quota share. I think the quota share gives you a feel, but if you're not offering your paper, you don't have any substance. The person giving the quota share has all the business. If you're actually a party that offers paper and sits beside another carrier, then you're in the portfolio as well. So you have a list of the risks and you have a renewal right as well. And I think a lot of people like that. They want to see how it goes. There's somebody we've got with the expertise to manage and do that portfolio, and they can sit along and enjoy it. And if they want to break off and do their own thing, they've got a portfolio that they can start with.
Right, okay, so it's really accessing the risks much more closely to be actually on the placement rather than giving a quota share to the people who are on the placement.
Correct, yeah.
Right, I get it. It's really interesting, since I started the podcast and since before I started the podcast, which is now 5 years ago, the growth in the MGA space has been absolutely phenomenal. Do you think it's going to carry on, or do you think we might be heading for a period of consolidation now that the market seems to have turned a little?
I think the consolidation would have happened if the market hadn't gone soft, or is getting softer this year. I think carriers will probably fall into the old trap of I'm losing my market share. How do I get it? And maybe MGAs become that alternative. That's something I hope doesn't happen. But we found that the MGA model was broken. The commissions payable and the deductions were far too much for how much profitability was left in the business. So we decided on our own new model for an MGA and how we would expect it to work. And currently we have some good partners that also see the same vision as us.
By the way, what's the MGA business called?
It's Scorpius.
It is a classic situation that happens that MGAs can do quite a lot better sometimes in a softer market as the paper is looking to continue growth in a market that's harder to grow into.
And I think people still wanting to purchase MGAs for multiples, until that stops, I don't see it changing. I think Lloyd's helped in a way when they looked at the commissions, about looking at how much original commissions being paid away. That had a knock-on effect in the business. But I still think some of those commissions are far too high in the MGA worlds.
Do you think, though, in that parallel time, we've had a lot of new MGAs that are really technologically and more skillful from an underwriting basis, that therefore could say that they've really earned their spurs in that sense, that they're producing superior returns for everybody? Is that fair? Do you think we've got a new breed that perhaps better at digital, the better at other forms of distribution, and better at analysing the risks, and therefore have earned that commission? I talk to a lot of people who are running MGAs of that sort, and of course they would all say that they don't exist just to be a post box. They exist to add value, and of course they should be rewarded for the value that they do add. But of course they understand that they've got to add value, otherwise there's no point for them to exist.
I think that's the problem. The digitalisation of the MGA does help, and it does reduce the original commission of getting the business, but then the MGA wants that commission as its own commission. So actually as a carrier, you don't see any difference in your net result. That's the biggest problem we have. I think the move in digitalisation and the way of AI is certainly helping. I mean, with call centres, with claims adjusting, it does give a benefit. But until the MGA realises that it's a partnership and that you can't burn the paper that's giving you your supply, if you like, things are not going to change, unfortunately.
So would you say that a lot of the increase in distribution through MGAs has been cyclical rather than a permanent change? Because a lot of them would argue it's a permanent change. They call it a secular change. It's a better way of doing things, and therefore that's the way things have turned out, and obviously that they're going to increase their share.
I think from what we've seen is the MGAs, which have been established over quite a few years, are probably not growing as much as they should. I think there is a lot of new MGAs growing because of computerisation and digitalisation. Because if you know how to build an IT system, you don't really understand insurance most of the time. There's very few that understand both. And if you don't understand that, then the pricing is the key to whether the product makes money or not, and how you get to the market and get the business through the door.
Yes, because we've had this huge amount of growth in the US E&S market that is distributed through MGAs. Where do you think that is going to end up? Do you think that there are chickens coming home to roost? Perhaps. I mean, I don't want to put words in your mouth, because it's been an explosive amount of growth. And I suppose you and I have both been around long enough to know that it's always right to be sceptical of fast growth in insurance. It's just one of those things. We've all seen it before. We've seen enough times that fast growth is not always a good thing. Let's just leave it at that. Are you looking at some of that fast growth in particularly US E&S with a raised eyebrow thinking, well, we'll see whether this business really is as good as they say it is?
I think what's changed, obviously with diversification back in the years when Lloyds and brokers had to divest from owning their own syndicates, brokers now own MGAs, and that's clouding a lot where the business is being placed and how it comes into London. Do you need to be part of a facility or a scheme? How do you get access to that business? I think fast growth is okay at certain levels and certain complication of risk. I think the simple risks with low value, I think AI and a lot of computerization to attract that business makes a lot of sense. But I hope it still stays a personal business, and I think the complicated risks do need to be done by underwriters. And I think that's something that being based in London gives us real access to a lot of expertise and technical people. And I think we are very fortunate at Antares that we've actually got very good people in all of our lines of business that actually make the profitability that we're after each year.
Yes, London market. How's that viewed strategically within your business? Is it right at the core of what you're doing?
If I go back from when I joined, Candour Re at the time was based in Switzerland and had 177 people. We no longer have the Zurich branch. Everything's been relocated to London. London really is the centric point of our business, and how we can get the expertise and the distribution and the skill set in to match what our risk appetite is.
It's really interesting you were saying about that distribution, the way things are changing in London, because there seems so many different ways of sort of slicing the same orange, aren't there? You know, you could be supporting an MGA, you could be on a broker facility, you could also be supporting an MGA that's owned by a broker.
Yeah.
And they all might be ending up writing some of the same business. I suppose that is also possible, isn't it? But is it just a natural way of things going as the market gets less friction, as we digitize, as some of the frictional costs of doing things one way or another all tend to the same level? Hopefully they'll tend to zero at some point, like the stock market has over the last 30 years. You can buy stocks and shares for nothing, which seems like a miraculous, obviously never quite nothing, but it's because of deal flow and all sorts of clever stuff that we perhaps as mortals don't understand. But going from something that would have been £20 to make a transaction, or £25, probably even 30 years ago, to almost zero and negligible. Is it something behind that the digitization of the marketplace might be playing into the idea that you can have huge creativity around distribution because it doesn't make much difference?
We've actually moved towards retail and commercial, which has really done away with the entity-based view That does allow us then to not duplicate risks and actually have a common approach to the business. But I suppose what really drives it is the capital efficiency. And that's something we've really strived to get into check in 2024. And in 2025, we are moving to streamline our capital in a much better way so that for the same buck, we get more use of our capital for how we've currently used it.
Again, is that another driver behind being in London? Because particularly with Lloyd's, you get great leverage in Lloyd's, don't you? And particularly now.
I think being in Bermuda and London does help. Bermuda is the gem in our crown, if you like, but it does need London as well. And together, I think it's quite an impactful force. Does
the Bermuda entity take a share of the syndicate, for example, that kind of thing?
So from this year, the Bermuda will provide the funds at Lloyd's for the syndicate, which actually makes capital work extremely well for us.
It seems to be such a symbiotic relationship, doesn't it? And seems to be incredibly complementary, so all good.
And they're right in the same business. The guys actually work closely together in Bermuda and London, but now it's just put into a plan that works. The business works, but now the plan works and the company works in the same way.
Looking forwards now, obviously the imperative we've spoken about, there's not always an imperative to grow in insurance. Is there any way where you're currently looking to grow? Where are you most happy?
We did our calculations of how important we are to the top 5 brokers, and the percentages were so low that just doubling those percentages weren't going to set the world alight, but it would actually bring us a big benefit. And if we go back, we were a 3 billion company a couple of years ago. We're now just over 1 billion, but we have the same operating costs, and that doesn't work. So we do need to grow. I think we've found the business that we like and it's profitable. We just need more of it.
You're going to be more of the same?
More of the same, yeah.
And that's because you've already trimmed down to the core profitable classes, so you just want to go deeper into those rather than diversify.
We're concentrating on the business lines that we have expertise and the skill set to manage and deal with. And actually the opportunities we're getting with the new insurance company, I think our targets should be reached in the next 3 years.
And what sort of target do you have to get back up to where you were with much better profitability?
I think within the next 3 to 5 years to be 2 billion. We do see that we can get to at least 1.5 billion in at least 2 years. So,
what about the market itself? Obviously, you look at some of the reports from a reinsurance perspective, some of those reports actually been very broad brush. The Howden report recently, the Howden Re report, is also global insurance and specialty insurance and everything else. It's insurance and reinsurance. And that title was just past the peak. So, one, would you agree that that's about right? But then how does that then play into your growth ambitions?
I think with our growth, we currently as a group don't really write property D&F. And if you look at the stats in Lloyd's and the rest of the world, a majority of the businesses that actually operate have a large D&F or property books, and that's something that's missing from our portfolio. I'm not saying that that's the one that we're after, but it's food for thought that how we could grow reasonably in the next couple of years just from getting some business in areas where we haven't performed that well in the past.
So that's somewhere where you might be thinking, I suppose, if you can find the right team.
It's all about the team. And I think whether you do it as follow or lead, I think it really just depends on the type of business and the computerization or the expertise of the automation of the business.
And also in terms of that rate adequacy, obviously we've given back a little bit at this renewal, but are you still happy generally with where that adequacy is sitting?
For the next couple of years, yes. There are some lines of business. I mean, we were predominantly a motor writer in the past. I think we have less than 10% motor now. So we do change with the opportunities we see and the profit potentials that we project.
It's always interesting with the mathematics of discounts is that if you give 50% off, you have to get 100% up to get back to where you started. Or 25% off means you need 33 1/3% to get back up where you started. It's when it's only 5%, people can't notice that maybe you need 6% to get back up to where you started. But it doesn't take long to start discounting before you run out of adequacy, I suppose.
I think because we've been through the restructure, we actually installed in people that we wanted rate increase, and we have achieved that. The negative of that is that when something goes as before, it still could be a good risk, but maybe the enthusiasm of writing it isn't there. And that's something we're working on to say it's actually what is at risk that we should be looking at rather than whether it had a rate increase. And it's a nice place to be, but it's something that you just need to be aware that it can affect you.
There are some programs that are just great, but they look cheap as hell on paper. But if you kind of know they're not going to have a loss, then You have to look the other way, don't you, sometimes?
Yeah, that's true.
If they're 10 times better
Few
than...
and far between, but I know what you mean.
Yeah, well, that's a small amount of the broker coming out of me just at that point. Obviously, if we don't get to see any business, we can't write it. In terms of the showing to London and your different outposts, how's that holding up? But London's one I'm always interested in. London is that peak clearing market. Some people describe it sometimes as the market of last resort. So when the market is hardest, it's when it gets its best showing, and then it might recede as local markets come back alive again.
About 2 years ago, we employed a broker, an ex-broker, and following COVID, I think everybody was suffering the same. Everybody was happy to do video calls, Teams calls, but not meet in person. And because we'd always been a company looking inwards and never outwards, it caused a very dramatic effect to the business. But with this guy joining, he actually got everybody to get out there and meet the brokers and do them business and actually create or back to personal dealings. Like if the banks all went ATMs and online banking, I suppose we were the same. Everything was email and everybody answered the emails and it was all great. Now, actually, we've got more interaction on a face-to-face level, and we've seen a massive benefit on that business coming through the doors now, and the relationship's growing again. So I think we made the right call a couple of years ago, and it's continuing the right way.
I must say, actually, my own experience, I was working in Madrid, and one of London focused carrier was very keen on growing, and they manifested that by hiring a broker who came to see me every quarter, pretty much. It was before the euro. He had a massive bag of all the European currencies, and he was always paying with loose change here and there. He had lots of spare pesetas knocking around his, they had Belgian francs and Swiss francs and Italian lira and everything else in between. But it certainly made a difference. It was always his job was to make sure that I should think of sending it to them first. And then if I did, I would copy him in and he would be broking that business on my behalf, sort of challenging those underwriters to say, well, why aren't you writing this? You keep saying you want to do more of this. And we've got orders from upstairs that we want to do more of this. So yeah, you can see that was a tangible investment from that carrier. And I'm sure it worked for them actually, yes.
Yeah, no, we've seen the benefits of it.
Absolutely. Actually, get back on rate adequacy. We've been spending a lot of time debating about casualty. Where are you standing on that debate, particularly the US variety?
We're actually not in the casualty space in the US. So we do have some small exposures, but it's nothing large. Our current underwriters don't feel that the reserves or the pricing levels are at the right place at the moment. Whether they will be in the next 18 months, I'm not sure. We have seen some areas making a change, but it's still not enough to be involved.
You've got international, though?
We've got some international casualty, but it's not a large part. We do have, obviously, insurance casualty business. Just going back, 80% of the business was reinsurance, 20% insurance. Now we're 80% insurance, 20% reinsurance. The insurance gives us the transparency that we want and the greater profitability as well.
You spoke a bit about technology and the impact of technology. We've been talking a lot about AI in the last 18 months. As it's being applied, and obviously we're all sort of using AI to a greater or lesser extent in our daily lives these days, where in the insurance value chain, where you've got some kind of use cases where you think, yeah, this is actually really useful?
So internally, we actually introduced AI to our banking system. And I think we were getting something like 20,000 invoices a year. They all go through AI now and they get generated to go into the bank account. Somebody still has to check it because obviously you don't just allow those things to be paid. But we were extremely pleased with the benefits we got there. In Doha, they have a large motor book. They actually use AI to price the claims and offer the repairs to garages. And that's all Google driven. So we've had meetings with Google and we're following up with Google to actually bring AI into some of our underwriting. The claims technology seems to be at the forefront at the moment. I think underwriting, we're looking at small premiums and small limits that we could actually put through into AI. It still needs a lot of manual intervention. And although AI is good, the people input is still important. I think the role of a person being a processor that turns into a manager is really key. You need somebody to just make sure it's doing the right thing. You're still reliant on somebody coding it correctly when it first gets described. If everything has its details correctly entered, you wouldn't have that problem. But you see that with risks that get, let's say they're called property and then there's liability in there. There's still this manual initial interaction that doesn't really work with the AI.
It needs someone to train it. I mean, it needs to know when it's done something wrong.
We'll only get better, yeah.
And what about on the underwriting side? certainly the applications I've seen, are just the classic, take a big email submission from a broker with a load of PDFs and Excel spreadsheets and goodness knows what attached to it and turn it into something. And sometimes actually go as far as putting it into a rating engine and actually coming up with a price on something that's more a commoditized type class of business. Obviously, where I've seen that was in the political violence or terrorism class, where the rating was kind of quite set. Again, saving a huge amount of time. Is it that kind of ingestion of that information and kind of making sense of it as if it was like an indefatigable type underwriting assistant who's going to take that submission and kind of get it into shape before the underwriter spends time on it?
I think we're looking at that. That's a little way off. I think where we've seen a massive input is on call centres, where when clients ring up, the details are found immediately so that people know who they're talking to, what their problems are, what type of vehicle they're driving, etc. On the garages, we've seen that can actually come up with estimates, and then they're making other garages offer to do the repairs. That's really good. We are currently looking at bordereaux because a lot of the business is through actual binders and line slips. One thing we have created ourselves is our own bordereau tool. I don't want to call it bordereau tool because that's still bordereaux, that's sort of 1970s. What we're trying to do is take a data dump of computer systems that MGAs run to get all of the data overnight and then upload that data so that we have a very recent detailed analysis of their portfolio rather than waiting for a month and then a month to close and then you're 2 months out of date. That data that can go through AI and have some simple checks being done is really for us the driver of how we're going forward.
So it's getting close to real time but not quite.
Yeah.
So 24-hour time, you know everything that happened yesterday.
And see trends. And part of what makes us different is that with every binder and line slip, we try to add value added back. So getting the data, analysing it, and then playing it back to the cedant, because most cedants want to feel that someone cares about what they're doing and is interested. And we've found that actually playing back the results that we find or the trends that we see, they appreciate it and the relationship just gets stronger and stronger.
Yeah, because that's where you can add value, because if you're working with 20 different partners in similar classes, you can say, well, I've noticed this thing's been happening in the north of England. Is it happening near you? Yeah. Or be ready for it, because it looks like, I don't know, a wave of new types of claim or
exactly, yeah.
Or just that there's cost inflation somewhere happening here in, well, I suppose, we've seen it in motor, 20 years ago, a bumper was just made of chrome.
Yeah, no.
And now it's got hundreds of sensors in it and it costs thousands of pounds before you just unscrew one, bolt another one on and thank you very much. And now, of course, you can't just call it a fender bender anymore because it's sort of many thousands of pounds bender.
No, exactly. Same with windscreens. I mean, windscreens are...
Because they've all got sensors in them now, haven't they?
Yeah, £150 and now over $1,000 for a windscreen.
Goodness me, right, I must make sure I tick the box that gives me windscreen cover on my next renewal. So
if you've got a new car, you definitely should. Yeah.
We spoke about those broker facilities, but we've got this further sort of automation. We've had, obviously, the key syndicate at Lloyd's. We've got similar things with Beasley, the smart follow. They're all different ways of, again, we're sort of using that metaphor, kind of slicing the orange in different ways. Is any of that of interest to you in terms of maybe trying out a venture that is semi-automatic?
I know we have some relationships with some Lloyd's syndicates that actually have an automation of some of the businesses, and we pick the risk codes and the line size. And this is our second year, and the first year's run well. I think everything's of interest. I think those automations allow you to go into a line of business, not incur expenses, see if it makes sense, and then take a view afterwards, or come out without upsetting the broker or its business model. So it's a very early stages for us, but I think each AI or product or automation or algorithm all has a benefit that we just need to work out how that suits our portfolio.
You're open-minded and you're always open, and if it produces a new way of producing profitable business, then you're interested.
As long as we've got the expertise to manage it and sit above it. What we're not doing, though, is writing something where we have no clue about the business, because you don't really know whether you're onto something good or bad, because the results it's telling you, no one understands it, then you shouldn't be doing it. You
still need to have your own view of risk,
correct? Even
if someone else is doing it for you.
Yeah,
that's absolutely fair enough. You shouldn't be writing quota share treaties in classes that you don't understand either, should you?
No, we don't do that.
If we're talking about long-term development of the London market, it seems to be the way things are going with the brokers is you've got a couple of leaders or maybe three leaders, for example, in something that they're really relying on to set the price, set the terms, work on the coverage and all the hard work on the wordings and all that stuff that people have to do. And then after that, they expect it to be just placed sort of almost automatically. Is that the way that the market's going in terms of what percentage of that follow capacity would become automatic?
Are we talking insurance or reinsurance now?
I would say insurance, but I'm thinking about the specialty market, that core London market business. Some of it's insurance and some of it's reinsurance, and some of it's reinsurance by name, as in the kind of DNF sort of world.
I think what's changed from the past is everyone has a view now on what policy wordings they want included. So I think there's also leaders that are acceptable that will get business home. Doesn't seem to be so many leaders now that are new to the market just to give the cheap price. I think it needs to have a reputable person there putting the line down, and the following markets already have a view whether they're going to cover war or these other exclusions that are topical. On the reinsurance side for us, we are our own leader. We price everything as though we lead it, and it's then not commodity all the time, but it's treated as a commodity. If you come up within the range, then you're accepted.
Yes, so it sounds like you've got an open mind there, but it bodes quite well, would you say, that because we're expecting leaders to carry more weight, I suppose, or because they're swinging a bigger line behind them and they're swinging more of the market behind them, that therefore we're only going to give that responsibility to people we really trust?
I think it depends if it's a capacity risk or a small risk. I think some of the smaller risks, we actually lead quite a few pieces of business. With part of the restructuring across the group was we're not really capacity writers. So we're not writing the 500 million limits. Or if we are, it's a price as a commodity. So I think in the past, everyone was after a certain price and everyone followed. I think nowadays, though, if I'm honest, I think there are differing terms and a lot of policies and products. It just depends on the appetite of the market and the business currently.
Do you think overall the market might become more stable with this, people only following more mature leaders, even if they're slightly automating that way of following them? Because you were saying it's harder for new leaders to come in and undercut everybody in the way that in previous soft markets, people would just turn up and knock percentages off.
If we're talking Lloyd's, I think there are some set leaders that probably won't change. But I think with the PRA currently and the FCA, the way that with consumer duty, everybody, even if they're not the leader, needs to do the due diligence and everything behind it. And that really just doesn't make sense, that everybody's doing the same job, checking on whether the vulnerable customer and the other parts of the consumer duty that you need to be aware of, just to get the risk home. And there are discussions that if a leader has done that, then some of that business can be used openly with the follow market. And that does seem to make sense.
I think I've come to the end of all my questions, Mike. Thanks very much for chatting with me. Perhaps for me, actually, the question I haven't asked is sort of, how do you want Antares to be known in the marketplace generally? Because obviously, you've got quite a diversified business. Under that one brand, what would you like people to say, that first word association to be when they think Antares? What would you like that broker to think of?
I think it should be an approachable company, a profitable company, mixed with a lot of fun and a lot of good people doing the business. I think we're lucky that we have very good employees here that always collaborate and get on extremely well. I think we're past the times where we had a lot of stuff to solve and create this new strategy and vision going forward, which we have. Obviously, with the lack of some of the resources in the market, we've actually started our own grad schemes, and we do encourage school leavers to join, because I think there's nothing that can't hurt you that you bring your own type of teaching to the people that work for you. And I know when I joined when I was 16, I didn't really have a mentor. I didn't really have people showing me what to do at such an early age. And I think we've tried to introduce that. So the words that get out to other people that their friends have just means that they get a much better experience here and hopefully rewarded for what they do and what they bring. We are a high performance company. We do expect people to go the extra mile, but we do hopefully pay and reward people similarly.
That sounds great. Well, have a good year, and we'll be in touch, I'm sure, at some point in the future to check up on how things are going.
Thanks very much. Thank you for having me.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.